It's time for Physician Family Finances, the show where physician moms and dads like you can get the answers and encouragement you need to turn a good earned income into great life outcomes for tomorrow and today.
Hello, physician moms and dads. I'm Nate Reineke, certified financial planner and primary advisor.
And I'm Chelsea Jones, also a certified financial planner and primary advisor here at Physician Family Financial Advisors.
Chelsea, it's still summer, and I noticed that in Oregon, at least where I am, you're in Florida, so it's different. But in Oregon, that's when talking about new cars or like wanting a new car always comes up. And I feel like it's just because everyone's outside and they're looking at everybody else's new car and they're getting like, I don't know, jealous. But when it's raining all the time, nobody's really thinking about that. They're just like holed up in their house. So I tend to get car questions this time of year from our Oregon clients. And I also am thinking about cars. I'm a victim of it too. You're like, man, a car's nice, as you're driving everybody around. So we have an asking for a friend questions about cars. And then we have 4 other questions from our listeners that we'll get to. What's the asking for a friend question this week?
So our asking for a friend question this week is, why is leasing a car all of that bad?
So this is like, I think, this is an asking for a friend question because you never want to ask a personal finance person about this because they love to talk about cars and just like beat you up over cars, right? And I'm not a
Pay
huge
cash.
pay cash. You're like, oh, why would you ever, and you do get just like beat over the head with a baseball bat whenever you buy a car. There's no way to buy a new car cheap. All right.
Right.
But this question comes from people who are like probably a lot more interesting and cool than people like me who are super into personal finance. So leasing cars, this is the finance 101. Maybe if your parents knew anything about money, they would talk to you a lot about cars because middle class gets obliterated by car loans. Like they really, middle class really needs to focus on not spending too much on cars. But doctors, they're looking at these payments. They see like, oh, the payment's not that much different. It's easier just to lease it. What's the big deal? So the way to think about this is the reason it's so bad, which I do actually think leasing cars is not, it's not
Ideal.
smart. Yeah. It's not a wise choice. But the reason it's considered so bad in this space is you're essentially paying for depreciation on a car. So you take the same car, let's say this was maybe this is a little dated, but let's say you got a new car for 50,000. I think they're like 100 now. But let's say you got a car for $50,000 and you make $1,500 a month payments for 3 years on the lease. $1,500 times 36 months is $54,000. So you've just now spent $54,000 over 3 years. And then you look at the payment and it's like the same thing. It's roughly the same. Question is, why shouldn't you just lease it versus buying it? Well, at the end of that 3 years, when you lease it, you give the car back. But if you bought it, that's about when the car starts to get cheaper. So now you're making progress toward the loan. And by the end of the loan, like a 5-6 year loan, you actually get to keep a $25,000 asset.
Yeah.
That's a depreciating asset. So, but here's the nuance, and this is why people who aren't big personal finance folks, like they don't really get it. A lot of times, people nowadays, by the end of that 3 years, they're just going to buy a new car again. They're just back at the lot. The amount of times I hear, my car's got about 50,000 miles on it. It's time for a new one. I'm like, I remember growing up, like if it didn't have 200,000 miles on it, it had a lot of life left.
Yeah. My first car, when I got it, had 200,000 miles on it.
Mine was close.
Yeah, it had me less, 100 more.
Yeah. It had less than 200, but it had a couple dents in it. So I bought it as if it was worth, had 200,000 on it. So there's more to this story about like why leasing is so bad, which is just how you own cars in general. Are you buying like the best way to buy a car is still buy 3 to 5 years old in cash and drive it until it has 200,000 miles on it, until it dies. That's still the cheapest way to buy a car. But if you are financially independent and you love cars, you just love cars, and you're going to buy a new car every year, which I would not recommend. This is not advice.
Right.
But
Yeah.
if that's what you're going to do, leasing it doesn't make a huge difference. Like, you're still paying for the depreciation, because the second you drive the car off the lot, it depreciates in value. It is now a used car, and you're paying that. You're footing that bill. The alternative would be much better way to own cars, or cheaper way to own cars, is let someone else pay that bill and then you buy it. Buying a car with 20,000 miles on it, it's almost new, feels new, and it's just cheaper. So is it all that bad? It's not necessarily the lease that's all that bad. It's how you own cars and how long you drive them. But if you are going to buy a car and return it in a year versus lease it for a year, it's pretty close. So, the good, wise advice is not to put too much value in cars and to buy used, but not everyone does that. So, lease isn't the end of the world. It's not going to sink the ship. You'll never own a car and stop making payments. So when you lease, the problem with leasing is that you will never stop having a payment.
Right.
That's the problem. Sort of like renting a house. You're just like renting a car. So that's it. That's asking for a friend.
Very good. Our first regular question is from a surgeon in Georgia. They said, we have a decent sized brokerage account, but found ourselves in a position with no emergency fund and a 5-figure emergency. Should we take out a HELOC or withdraw from the brokerage account?
So first things first is this is a huge call for or reason to have an emergency fund. It's because you're put in a position where you have to borrow money, or you have to pay, presumably you'd have to pay taxes to get to the money in your brokerage account. Not the end of the world. You can pay the taxes, you can pay the interest, and you'll be okay. But get an emergency fund, treat it like the foundation to your plan. So 5 figures, mid 5 figures is very typical emergency fund for most physicians. Actually, it's probably small for most physicians.
Yeah, I was going to say, seems kind of low.
But... Yeah. So, but now that you're in this position, maybe you had an emergency fund and had to spend it. You had the old back-to-back emergencies, which is unfortunate. The question is, should we get a loan or should we take it out of a brokerage? And there's kind of 3 things to look at. It's one is opportunity cost. So like keep the money invested. That's difficult to determine. We don't know what returns will be in the future. But you kind of gauge this with your plan. Like if it would be catastrophic for your plan to pull this money out, you should consider maybe taking out a HELOC and paying it off as quickly as you can. But by the same token, you can replace your brokerage account just as fast. So the only thing I think about here is behavior versus math. A lot of people are more intent on paying down a loan than they are catching up with their investments because they hate paying interest. But if we set that aside, then you're looking at interest rate versus taxes. You set aside the opportunity cost of investing because the investments might go down. What is the interest rate on a HELOC and how much taxes would you pay? So,
and I would say, how long do you plan to take to pay off the HELOC?
Right. Like let's say you have a bonus coming up and it's in 6 months or 3 months and you could pay off the HELOC right away. Well, as soon as you sell those stocks, you guarantee yourself a tax bill. Whereas if you might get a big bonus, then there's no guarantee that you're going to hold on to that HELOC balance for a whole year. So that's a good point. But maybe you don't get a bonus, or you're not going to be able to pay it off, or when you're going to be able to pay it off. And let's say it's a year, you have to take out $50,000 right now. I know of a really good HELOC you can take out in most states where it's prime, Wall Street Journal prime, which is an interest rate that gets set. minus 0.5%. So it's a pretty reasonable interest rate. I think it's around, I think right now it's around 6%, maybe 5.5. Let's say 6% interest for a year, you're gonna pay $3,000 in interest. So you can go model what it would look like to take the money out of your brokerage account. And if you're going to pay more than $3,000 in interest and tax, or if you're going to pay more than $3,000 in taxes, then it would make sense to get a HELOC. If you're going to pay less than $3,000 in taxes, it makes sense to take it out of the brokerage. But once you set aside behavior and you kind of take a step back from your plan and realize, like, one way or another, I got to get to this money. One way or another, I'm going to have to replace it, either in by paying it back on a loan or replacing a brokerage account. It's just taxes versus interest.
Okay. Our next question comes from a pediatrician in Oregon. They said, I have been a diligent saver for much of my career, and on top of that, I just received a sizable inheritance of a couple $1,000,000. I still plan on working until age 65. Can I start overspending on travel a bit now? So I actually love this question.
Mm-hmm.
Or I love when I can give the answer that this couple got, at least.
Yeah.
So basically they're saying, I have my plan's on track, and then I got this windfall on top of it. Can I spend some of it?
Mm-hmm.
And when we get down to the brass tacks of this question, like, you need to be able to enjoy your money now too.
Mm-hmm.
We're big on, and you'll see this if you do planning with us. I constantly am talking about a happy medium. We don't want you to shove every dollar that you have into some kind of savings account, and then your mental health and your happiness and your ability to enjoy life now comes at the sake of that.
Yeah.
And so, yeah, if you can reasonably expect to cover the higher expenses without putting your retirement in jeopardy, then yeah, go for it.
Yeah.
It kind of goes back to our kind of philosophy on budgeting. Like, you need to know how much you need to save, everything, and spend on bills. Everything beyond that is up to you. And so this is a little bit different because it's already in an investment account. It's in an inherited IRA, I would assume, or maybe a brokerage account that they inherited. And so it's not like they're getting a paycheck and asking, can I spend it if I've already saved?
Yeah. I think right there is really why this question even gets asked, because, back of the napkin, they're like, I have millions of dollars now. I like work. Can I spend this? And they've trained themselves to view investments as not, you can't touch that. And so it's just a paradigm shift of, when am I allowed to touch it? And oftentimes people are about to retire have the same paradigm shift. They really struggle with the shift from, this is savings, you never touch it, and now it's time to spend it.
Mm-hmm.
So, they have millions of dollars. They're diligent savers, which means they're probably not big spenders. And now they're like, am I allowed to be a big spender?
Yeah. Or at least a bigger spender.
Yeah.
From what I gathered, they're like, can I just travel a bit now? It's
Right.
not like, can I go out and buy $150,000 car and, like, do something crazy. They're just like, can I take an extra vacation this year?
Right. Yeah.
Yeah. Please do it.
So
But
inherited IRAs, I assume that there's like the technical aspect of this. They have an inherited IRA and probably some form of a brokerage account. That's what most people inherit. What would be like the best way for them to spend this money?
Well, with inherited accounts, specifically pre-tax inherited accounts, well, all non-spousal IRAs are subject to the 10-year rule now. So if you inherited accounts from your parents, that would be non-spousal. So you have to take the full balance out by the end of 10 years, regardless. And that could usually mean taking it out in smaller chunks over 10 years, or it could mean taking everything out in the beginning or taking everything out in the end. So the money is coming out of the IRA regardless. The question is just when. And usually how we include that in the plan is we just assume that those distributions get reinvested in your brokerage account.
Yeah. So we have been there have been times where people get these distributions out and then they just assume they can go spend it. And so now here at Physician Family, we just invest it for you. Like, yeah, we're just going to reinvest this. which is great because you end up with a big giant pile of money. But if you don't remember that that's going on, you assume that this money is not ever coming to you. But if you get the money out and you already have to pay the taxes on it because it's inherited IRA, you're not causing an extra tax bill above and beyond what you had to pay to spend some of it at this point.
Right.
Right? Yeah. So, not that you won't pay taxes, but it won't cause an extra tax bill to spend some.
Yeah. The taxes were going to happen anyway.
Mm-hmm.
So
a
yeah,
couple million
maybe.
bucks, inherited IRAs, maybe it's half that. I mean, you have a big distributions coming out, like
Mm-hmm.
6 figures worth of distributions. And, of course, make sure that here's one thing I always think about in these situations. And in this situation, a diligent saver for many, many years and throw in $1 million on top, a couple $1 million on top of that, they're completely safe to spend some of this money.
Yeah. Yeah.
But something that can happen in these situations, let's say the margins are a little bit thinner, like maybe you weren't such a diligent saver and maybe you only got $1 million. What can happen is your taste for the expensive things in life goes up because now you
Mm-hmm.
have this money that you weren't expecting, and now you love to spend 50, 60, $70,000 a year on travel, but your plan can't sustain it forever.
Right.
So that is something to consider at least. It's hard for people who have lived like this for a long time. A pediatrician isn't the highest paid specialty, and it's hard for people who have saved on that salary for many years to overspend so much that they're going to blow through several $1 million on travel.
Yeah. They've done the work to get to the point where they are. It would be hard. Because, like, I can kind of empathize with their position. Like, if I saved diligently for so many years, I would be afraid to spend too much and, like, wreck the hard work that I put in.
Yeah.
If I didn't know the consequence of spending some of the money.
Yeah.
So,
and they are in a unique position too with this, which is they have plenty of money to retire. They actually asked me, "Can I just save less?" And my heart broke because I'm like, "Please don't, because you're going to pay a whole bunch of money in taxes." Like, we save money in our 403bs, our 401ks, and our Roth IRAs for retirement, but it's also a tax arbitrage.
yeah.
So I would rather them spend all the money out of, well, not all of it, but a good amount of the money out of these forced distributions
Mm-hmm.
and save money so that you can defer into your 403b or 401k while you're in a high tax bracket. So this is that money could be spent. You can also avoid pulling money out of the brokerage account with these distributions, inherited distributions, and
Mm-hmm.
pull it out of your brokerage account when you're in a lower tax bracket as well. So this is unique, but it's not like it never happens. About this time, right when you've been a diligent saver for 20 years, is when you might get a bit of an inheritance,
Mm-hmm.
and it's worth planning through and deciding on if you want to spend some of it.
Yeah. Just intentionally spending it instead of, what's the word I'm thinking of? Just like on a whim, saying, "Oh, I got this. Let me."
Mm-hmm.
Okay. So our next question comes from a family medicine doc in Texas. They said, "I'm working toward PSLF, Public Service Loan Forgiveness, and I've heard about the buyback program. What is that and how does it work?"
Yeah, the buyback program is, I would say, pretty misunderstood. Not exactly like at a high level what it is, but the mechanics of how it works. It reminds me of almost 10 years ago when I first started helping doctors with PSLF. It was misunderstood, not that just at a high level your loans get forgiven, that part wasn't misunderstood, but how you actually get it was misunderstood because it was so early. They had never spoken with anybody that had actually gotten it. So
Mm.
2017 was the first year anybody could have ever gotten it because the program was released in 2007. So from the day the program was released to 2017, you would have had done all your paperwork right. You would have been on an income driven plan the whole time. You'd have had to worked at a nonprofit the whole time. You'd have not skipped any payments. And so it looked like everybody was getting denied for it and that it wasn't real. But it was really just that people didn't understand how to execute a student loan plan.
Hmm.
So it's similar here. The buyback program, I'll tell you exactly what it is. And I'll use an example. Let's say that there was a period of time where you worked for a nonprofit and you were in forbearance. Okay, so you're in forbearance and you realize, man, I really shouldn't have been in forbearance. I wish I would have made my payments, but I was in forbearance and now I have to wait, an extra amount of time to get my loans forgiven. And it's the worst time because I now make more money than I ever have. So I'm gonna have to make, let's say, 10 extra payments during the 10 months I was in this forbearance at the highest rate. Okay, so you're sitting there, you've made 110 payments toward public service loan forgiveness. You have 10 left to get to the 120 10-year mark. But the buyback program was released and they say, well, if you're in forbearance and you checked all the other boxes, you just weren't in the right payment plan because you're in forbearance, you can submit to pay for those payments right now. So let's say it was during residency when you weren't making a lot and you went into forbearance because you didn't want to pay the payments. They're saying, let's say your payments were $100 a month in residency, or they should have been, but you were in forbearance, and there's 10 of them. You give us $1,000 right now, and your loans are forgiven. Sounds like a sweet deal.
Yeah.
The issue is, the reason it's kind of misunderstood and why nobody has, there are people that have gotten it, but they're hard to find, is that you can't apply for the buyback until the result of the buyback program would be forgiveness. So let's imagine that same situation, but you don't have 110 qualified payments, you have 105. Okay? And you have 10 payments that you want to buy back. If you bought those payments back today, you would only have 115 qualifying payments. Therefore, your loans would not be forgiven. Therefore, you will not be approved for the buyback. You need to wait 5 more months so that the result of the buyback would be forgiveness. Now, this is the problems I'm running into now. They are taking forever to process these requests. And I got a number here. I looked this up. There was 88,000 requests were pending at the end of April 2026. And the department's best month, in their best month, they cleared about 7,000 of those requests. So there's an enormous backlog of requests. So you're sitting there waiting, wanting to get in line so that they will process your request. But it's going to take them, at least at this rate, at least a year to get to your
just to
request.
get through the ones that are already pending.
Yep. And so the question is, well, do I now leave my nonprofit job like I wanted to, even though it's going to take them a year to get to it? What if they decline me for some reason and now I have to go back to a nonprofit for 10 more months instead of getting my request granted? That is a difficult question to answer in a vacuum where you just say, oh, yep, it all makes sense. You're going to get approved for this. I would say don't leave the income-driven plan. Just stay on the plan, keep making your payments. And in chronological order, they should refund you the overpayment, which again, hard to find people that or see an example of where the refund actually happens in a timely manner. It sort of feels like you're going to wait a year to get approved. Hopefully you get approved. And maybe you're going to wait another year to get your refund. So when you thought PSLF is over, right now, if I submit this form, you're in a 2-year waiting period. And it really just sucks to wait 2 years and not feel done. So what I would recommend for listeners who they want to look into this would be, if there is a minimal amount of savings, if you determine that there's a minimal amount of savings and it would be worth just paying it for 10 more months, like let's say it's going to save you $2,000, but it might be worth it just to spend the $2,000 to get it forgiven versus waiting 2 years, kind of on pins and needles. This family has big plans for when their loans are over, so they're gonna wade into the treacherous waters of the student aid department.
Mm-hmm.
But I will say that a lot of those requests that did get processed were approved. So it's not like they're just denying you for no reason. And as far as the refund goes, they haven't written a lot about this at the Department of Education, so it's still a bit of an unknown. The landscape for student loans continues to change all the time, but that is what it is, and that is how it works.
Mm-hmm. Right. Our last question comes from an emergency medicine doctor in Oregon. They said, I feel pretty risk averse, but I've been told I should invest aggressively while I'm young. What do I do? This is a really interesting question because it's kind of, at least in our minds, so as financial advisors, it's counterintuitive for a young person in their 30s to be risk averse, which to us usually just means invested less in stocks and more in bonds if you're risk averse. And when I get this question and I actually dig into it, it's less about the actual risk than it is about understanding where the risk is coming from. Like if you don't understand what you're invested in, it's going to feel really risky.
Yeah,
But if you know what's behind,
I think about it like this. I take my dog on a walk, and there's this really nice loop around it's not even our neighborhood. It's like a public path, but it's near our house. And there's this part of it where you go over a bridge over a river. And my dog sees the river, it hears the river, it thinks, I don't want to fall in that river. And it does not know, because it's a dog, it does not know that how reliable a bridge is.
Yeah.
Right? Like, but if I could just say, hey, my dog's name is Moses. Moses, this bridge is okay. Like, yeah, there's some risk here. You could jump off the side, it could break, but like you're probably okay. But as human beings, we're totally comfortable with that risk because we understand what a bridge is. Stocks are riskier than bridges. I want to say that, but or at least most bridges. But yeah, it's like you don't really understand what you're doing. There is risk involved, so you just kind of say, I don't really like risk, but like, what is risk? You know, like what risk are you taking?
Yeah. But usually, whenever we have that conversation and we get to the bottom of like what actually feels risky, it's more about understanding that it is about the actual risk that they're taking on. It's like understanding what the risk actually is. Because like I said, with us, we don't do speculative investments. We don't do, we don't typically recommend things that are riskier than stocks, a mix of stock and bonds. So, yeah, more risk to us means a larger percentage of your portfolio is in stocks. And when we talk to clients about that and kind of break open maybe the funds that we would recommend they invest in, they see I am actually investing in thousands of different companies. And in order for me to like actually lose all of my money, some catastrophic things would have to happen. Then that makes them feel a little bit better because the actual risk of losing all of the money is relatively low. The value will of course fluctuate, but one of the good things about being, a young 30 something doctor that's just starting out is you have time on your side. You have time to withstand the ups and downs in the market, and history shows us that you usually come out on top in the long run. If you're responsible.
I had to go through a valuable but somewhat unfortunate experience of talking to another advisor, who, in order to invest her money, they needed to talk to my spouse. Like she had a interesting plan at work. It was like a really small company, so it was a simple IRA they set up, and so they had to get her risk tolerance. And I'm over there like signing to her like more risk, like because she says they're like, what's your risk level? And she says, I don't like risk. That's my spouse. And I'm like, no, more. It's like I wasn't allowed to just tell him for her what we're going to invest in.
Right.
But it's a kind of a disservice in some ways if you stop there or you just ask someone these theoretical questions about like how much risk do you like to take. And I know we have to do that in our industry and we do that, but the better way to do it is get a feel for someone's risk and then explain to them what they're going to buy. And so anytime that you and I, like we call it lifting up the hood, we look inside of a fund and you actually look at the names in the fund. Like, go look at the positions that you're buying, the companies that you're buying a stake in. You'll probably recognize the top 50 of them. And you're just like,
Exactly.
what would have to happen to actually lose all your money? What would have to happen for, you know, Tesla, Netflix, Meta, Google, Johnson and Johnson? Like, what would have to happen
Apple,
for
yeah.
yeah, Apple? What would have to happen in our country for all of these things to go to zero?
Mhm.
Like, there would be no place to hide if all these places went to zero, right? And what would have to happen for all of those things to go to zero, and none of the companies below them to replace them, like to switch the order of the top companies now becoming middle companies and the middling companies not to somehow improve and take over the top spot and do really well, because that is typically what
Mhm.
happens when you're seeing fluctuation in the market. It is big giant companies getting knocked off the throne and middling companies innovating and becoming top companies.
Mhm.
So if your question is like, I might lose all this money, I guess there's always a chance, like anything could happen. But the idea that the entire world economy will not continuously improve like it always has over a very long period of time is relatively low. So when you look at that and you think about how long you have as an investor, as a young uh, doctor, most of the time you realize I am taking risk, but the question is how much can I stomach fluctuations versus
Mhm.
what I assume they think is I'm buying into a stock that could go to zero. But if you're buying thousands of international stocks, thousands of US stocks, and coupling it with some bonds, that is more diversified than what they're assuming, which is buying a few single stocks and hoping that they skyrocket.
Yeah. Yeah. To take that back to a bridge analogy, your bridge analogy, I had a friend who was an engineer explain bridges to me once. And like, everything's triangles. And they're like, each of these points takes a little bit of pressure off of this and this and this. And I was like, okay. But now that I'm thinking about it, I'm like, if you just have a bridge with two poles and you're
Mm-hmm.
not well diversified, it's not going to take as much to knock it down. But if you have 1,000 different companies taking pressure off the portfolio
Yes.
through diversification,
Mm-hmm.
it's a stronger bridge and it's going to hold up longer. And it would
That's
take like
good.
an earthquake to knock it
Yeah,
down.
exactly. Ladies and gentlemen, we did not practice this.
Yeah,
The bridge analogy made it the whole way through.
it
Yeah,
did.
no, that's very true. And so what I have seen, this does not mean this is for everybody. Someone could see that bridge and be like, "No, thanks. Like I'm going to walk around." And so what does it mean to walk around? You got to save more because you're taking less risk, therefore you're expecting a lower rate of return. Probably have to spend less. And if that is
Mm-hmm.
you, that is okay. That is okay. But most of the time, when people actually understand what is inside of the portfolio or inside of these mutual funds or index funds that they're buying, they do get more comfortable, and their appetite for stocks goes up by some degree. Maybe it doesn't
Mm-hmm.
double, but sometimes it's like, I don't need to, be in all bonds. I could buy some stocks. So, but it's a good question. I think lots of people feel this, and lots of people feel pressure around, like, I've just been told I need to be aggressive, even though I'm uncomfortable with it. And that's not appropriate. If you can't
Mm-hmm.
stomach the fluctuations of the stock market, you shouldn't own stocks. It's just that most people, when they understand it at a high level, they feel more comfortable with it.
Mm-hmm.
Okay, I think that is it for today. Thank you, everybody, for listening. If you liked this episode, please be sure to subscribe. We release one every week. You can send us questions at podcast@physicianfamily.com, or you can visit our website at physicianfamily.com. We will answer all your questions either by email or on the show. Until next time, remember, you're not just making a living, you're making a life.
Are you ready to turn worries about taxes and investing into a plan for college and retirement? If you're evaluating your options and want to learn more, visit physicianfamily.com and click Get Started. Or you can ask a question of your own by emailing podcast@physicianfamily.com. See marketing disclosure at physicianfamily.com/disclosures.